This is Horizons Middle East and Africa. Our top stories this morning. Back on, Canada rescinds its digital services tax in a bid to resume US trade talks. But with just 10 days to go until elevated tariffs are set to resume, the White House looks set to fall short of the sweeping global trade reforms that it promised to achieve. President Trump signals a ceasefire in Gaza could be coming as soon as this week, but gives no details on how an agreement might unfold. And the Democratic Republic of Congo and Rwanda agreed to a US-backed peace deal to end years of deadly conflict. It's just gone 8 a.m. across the Emirates. I'm Lizzie Verdon in Dubai in for Jumana Basechi. Welcome everybody to the programme. It is Monday the 30th of June, the end of the month and the end of the half. And the question is, are US stocks going to power even higher? They already hit a fresh record on Friday, and you've got futures pointing higher on both sides of the Atlantic this morning, fuelled partly by that trade optimism. But the question is, how long can this last? Flip the board over and you can see that bond traders are braced for Fed cuts. And when you look back across history, only one easing cycle since Paul Volcker has not ended in a recession. So how long can this expectation of US stock outperformance continue alongside that expectation of Fed cuts? There's one chart else I want to show you as well. Flip the board again. The outlier in all of the rally in the first half of the year among commodities, credit, stocks and bonds has been the currency, the dollar. And the flip side of that has been strength for the euro and the pound. And partly that comes back to the central banking story. So I talked about those Fed cuts that we're expecting later in the year. The ECB, on the other hand, is coming to the end of its cycle. Maybe it's already there. And you're going to see that playing out this week. Tomorrow in Sintra, you'll have the juxtaposition personified of Chair Powell and President Lagarde alongside each other, the ECB and the Fed. That's the first time they've been alongside each other on stage since that same event last year. And we'll have full coverage of it for you right here on Bloomberg TV. But we've got two key deadlines coming up. July 4th, when President Trump wants his big, beautiful bill signed, sealed and delivered. And then July 9th, when higher tariffs are going to kick back in unless deals are done. They're ambitious timelines, but are they possible? Let's ask our senior editor, Bill Ferries. He joins me now. Bill, good morning to you. We've got good news this morning on trade. Canada rescinding its digital services tax to advance the US trade talks. Just talk us through what other sticking points need to get done to get a deal over the line.
Well, that was one of the big ones. Obviously, Donald Trump cut off trade talks with Canada over frustration over that digital services tax, which really was seen by many analysts as leverage that Mark Carney had in case he needed it to get talks jump-started again. So it looks like Canada is going to play that card. They're going to rescind that tax, get back to the table, and they look like they got a little bit of an extension on their trade talks to July 21st. But when you talk about what's at risk here, or what else could be in play, I mean, basically everything. Canada has been hit hard by the trade threats from Donald Trump, although Canadian consumers are huge buyers of American goods. So, I mean, you're talking about everything from the trade in autos to things like aluminum, steel. Softwood lumber is always a big issue. Canadian dairy is a big issue. So all of that still to be negotiated, but Canada has bought themselves a seat back at the table and a little bit more time to reach an agreement.
OK, so Mark Carney back in Donald Trump's good books for now. But in terms of the other deals that we're waiting for, the president says July 9th, that deadline could be brought forward. Treasury Secretary Scott Bessent, though, says that it could be extended. So, Bill, what's the sense of what could get done by July 9th?
Well, you said it. It's all over the board in terms of the messaging from the administration. Scott Bessent really signaling that a handful of countries that are seen as negotiating in good faith will possibly get extensions. We think this includes governments like Taiwan, Japan, perhaps South Korea, perhaps the EU. there could be extensions there. But then Donald Trump also signaling that he's willing to just make announcements about what some economies, what some countries will have to pay and end the talks. We're not getting close to the 90 deals in 90 days that trade czar Peter Navarro promised at the beginning of this. It's not clear if we'll even get a full trade deal with any single country. What we've seen with the UK and China so far has been that the administration reaches some kind of a framework agreement, and then they continue to negotiate the details in the aftermath of that. So I think we're going to get a very mixed bag when the calendar turns to July 9th. Some countries might get a little bit of relief. Some are going to be back in the doghouse, so to speak.
Yeah, and let's see whether we get substance as well as speed. But putting trade on the side for just one moment, let's also think about the other deadline that's coming up, of course, July 4th, the deadline for the big, beautiful bill, the $4.5 trillion tax cut package. It's advanced in the Senate over the weekend, Bill. But just talk us through what compromises had to be made to get this far and what still needs to be worked out from here.
Well, quite a bit still needs to be worked out. What the Senate has done is they've, different from the House bill, they've made a handful of the business tax breaks permanent. They've reached a rough agreement on those state and local tax deductions, those SALT deductions that have been so troublesome for this bill. They basically keep that $40,000 cap on SALT, but they phase it out after 5 years. That's something that wasn't part of the House bill. The Senate bill that's we're expecting the voting to begin on the amendments to at 9 a.m. in Washington. That legislation costs about $500 billion more over 10 years, according to the Congressional Budget Office. So that difference in cost, the extra costs, that's going to be a hard pill for a lot of the fiscal conservatives to swallow. There still could be quite a bit of negotiation once the amendments start on that legislation beginning Monday morning in Washington.
OK, with the latest on the bill, Bill Ferries, we thank you, our senior editor. And for more insight into where the trade negotiations stand, don't just take Bill's word for it. Bloomberg's going to be speaking to the US Treasury Secretary Scott Bessent later on today, so don't miss that interview at the Times on your screen. Now, let's get some more analysis. Joining me on set is Ryan Lemand, who is co-founder and CEO of Neovision Wealth Management. Always good to see you, Ryan.
Good morning.
You have these two deadlines we were just discussing, July 4th, July 9th. Do you expect a lot of volatility heading into those dates?
Absolutely. And regarding these dates, everything is fluid. We've seen it. Nothing is certain. It's all speculation. Everything can change from one day to another. Everything is driven by the negotiations that President Trump and his team are doing. So these dates, I don't think they're cast in stone at all. And many things can change. OK,
so maybe you're not so optimistic that we'll get all of these deals. What about not just the speed, but as I say, the substance? What if they're just MOUs? Does that really lower the trade risk?
I do think that these deals that will happen will not be as good as forecasted or as good as President Trump expects. I think he placed the bar very, very high to reach something that is mutually acceptable with the different countries he's dealing with. Let's not forget, Canada, for example, is a very friendly country, and I don't think President Trump will push it too far because he needs, from the northern borders, a very friendly country.
And we started the show looking at the futures picture. You can see it here, green across the screen. The S&P already hitting a fresh record on Friday. When you look at that, do you see that as complacency? Do you see it as resilience? Is the outperformance going to continue?
So let's divide it. We're looking at the rates market, which is driven by institutional investors, and then stock markets at the moment driven by retail investors. I mean, look at the call options volume. It is literally exploding. It has never, ever been higher. So it's not all of it, but most of it is speculative, and that's a bit worrying. The second thing is earnings. We need earnings to catch up a little bit with valuations. Valuations are through the roof at the moment. The third metric I'd like to bring is small caps. If you look at the valuation of small caps in the US versus mega caps or even big caps, it has never, ever been as low as it is today. So all of these metrics are a bit worrying. So for investors who can disregard valuations and fundamentals, yes.
But so are you expecting that valuation gap with, say, Europe to close?
So Europe, for example, has done very well, not only on currency, but also from a fundamental perspective. Europe is a savings nation versus the US, a consumption nation. So today, the European model is attracting more and more institutional investors, given the huge spiraling debt of the U.S., the spending that is taking place, the deficits, current account deficits. So with no plan in sight on how to reverse these. So people are going more towards Europe from an institutional perspective because it looks more sustainable and a bit safer, I have to say, from a valuation perspective.
Yeah, we talked about rate cuts as well. There's been all of this speculation that the president's going to pick Chair Powell's replacement early. It's been played down by Treasury Secretary Scott Bessent. But of the runners and riders that are floating around, who do you think would be credible to the market?
Well, the name that is really circulating at the moment is Treasury Secretary. And I think that wouldn't be the best case scenario for the U.S. because he's very dovish. So if he really reduces rates, given tariffs that are coming in and where we are in the cycle right now, I think inflation could come back with a vengeance.
As in he'd be seen as political?
Yes, yes. I think Jerome Powell, I was critical of him a couple of years ago, but he has really proven that the Fed is independent, that his decision is independent, and he's really holding on. I completely changed my mind about Jerome Powell.
OK, so where does it take yields then if you end up with Bessent as a shadow chair?
So basically, the bond vigilantes on the rates market, institutionals, are saying we are worried over the longer term.
Because, of course, they get the say way before the Senate.
Yes, yes. So yes, there will be a divergence, I think, between the policy making, if Treasury Secretary comes as a chair for the Fed, and what the market thinks is right.
And how much would it undermine Powell to have the name circulating way before actually the new chair takes office in May next year?
Oh, Lizzie, you want to talk about undermining? The president of the U.S. has called the chair of the Fed an idiot. So how about undermining? So it's the strongest nation in the world, but the president is calling the Fed chair an idiot.
But we're used to this sort of language from the president, right? Does it actually make a difference in markets' minds?
Well, the market...
Does it put pressure on Powell, real pressure?
Obviously, the pressure on Powell has... I've never seen pressure on a Federal Reserve chair as much as we're seeing with Jerome Powell today. And he's holding up, which is great. And Jerome Powell today is lost between, or not lost, but he's watching whether tariffs will be passed along to end consumers or absorbed by companies. Until now, companies are not absorbing the tariffs and they're passing it to consumers.
Enough pressure for a July cut, maybe?
No. No cuts.
OK, Ryan, good to see you. Ryan Lemand, Neovision Wealth Management co-founder and CEO. Always good to get your insights. Thanks for stopping by. Still ahead on the programme, we're going to bring you the latest from the Middle East on Iran, but also a potential Gaza ceasefire. We'll go live to Jerusalem next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Now, President Trump says that he thinks a ceasefire in Gaza could be close, perhaps even coming as soon as this week. He says the US is supplying money and food to the territory, but he didn't give further details on how an agreement might unfold. So let's get some analysis now. We can go to Jerusalem and speak to Bloomberg's Dan Williams. Dan, good to have you. Just talk us through what we actually know about the progress of these talks.
Well, as you noted, we're into a new week after really an astonishing series of developments last week. That ceasefire brought about by the president in an unprecedented Israel-Iran war. I think it would be fair to say that President Trump saw his intervention, his military intervention in that war with those strategic strikes against Iranian nuclear sites that he ordered, as a means of bringing about peace as he would see it. And I think now he wants that delivered on. So he's been speaking, perhaps aspirationally, of some kind of deal that would wrap up the Gaza war, effectively the two bookends, the Gaza war and the Iran war, ending what is now an almost 21-month-old war in the region between Israel, Iran, and various Iranian proxies. That has not really found purchase in Israel, while the Israeli Prime Minister Benjamin Netanyahu also said it was time to look for a shift, an achievement, a release of hostages, perhaps peace deals in the region, new peace deals between Israel and Arab partners that would come in the wake of a quieting of that war. Is really short on details. It's very hard to see how that could be brought about anytime soon.
And Dan, you and our colleague Peter Martin had a fantastic piece over the weekend, really setting out, on the one hand, how Israel's become more military dominant in the Middle East over the past 2 years, but also how it's laid the groundwork for more risks. Just talk us through what those risks would be.
Well, as noted in the story by Peter and myself, Israel has gone through a 65% increase in military spending last year. This is hardly surprising given Israel's general war footing after the October 7th attack by Hamas in 2023, which set off this regional conflict. Israel was both besieged, beset by enemies on all fronts, but it also had a very hard-nosed, forward-leaning approach, meaning that it would take the war to its enemies, and that required major spending, major training, major hardware. So while there's no doubt that it has achieved preeminence militarily in the region, and that may certainly pay off in terms of defense deals in the very near future, there is some worry that perhaps it's become over-reliant on the military option, especially in a place like Gaza, where Hamas, though massively outgunned by the Israelis, has held on in pockets of the Gaza Strip. The fate of the hostages it still holds is unclear, short of negotiation to release them. So there is some concern that perhaps the Israelis may be over-reliant on this and may experience actual blowback in terms of their diplomatic standing, in terms of their international standing.
And Dan, I just want to also get the latest on Iran, because President Trump has said that he might back sanctions relief if Iran can be peaceful. That's the way he's putting it. Of course, this week we were expecting potential nuclear talks. Where are we on those, and where are we on even a potential peace agreement between Iran and Israel?
Well, a peace agreement between Iran and Israel would appear impossible anytime soon. It's worth remembering that the current Iranian administration, going back to the Islamic Revolution of 1979, on an almost constitutional level is committed to seeing Israel destroyed one way or another. It's very, very hard to see how, short of a complete regime change there, Iran would be willing to engage directly and constructively with Israel. As for what Trump wants, Trump is a deal maker. He has had talks with Iran in the very recent future. However, his offer, if it is an olive branch, of sanctions relief appears to have been scrapped after the Iranian supreme leader made comments that were not pleasing to the ear of the US president. Defiant comments suggesting Iran actually won this war. The president was not happy about that and appears to have stepped back. We're not anticipating nuclear talks anytime soon, and indeed it would appear the Israeli Prime Minister Netanyahu is on his way at some point in the near future to visit the United States in hope of weighing in with his opinion when it comes to discussing with Trump how to handle any future diplomacy with Iran so that the US gains, the Israeli gains in this war can actually be shored up diplomatically.
OK, Bloomberg's Dan Williams, thank you so much for your reporting this morning. And on the subject of that fragile truce between Iran and Israel, let's just check in on the oil market. You've got Brent there at $67 a barrel. It had its biggest weekly loss in more than 2 years last week. But now we turn our focus to that OPEC Plus meeting on Sunday. Analysts expecting another supply hike. It would be the fourth straight supply hike. So geopolitics kind of moving to the background and OPEC Plus moving to the foreground. We keep an eye on oil. But coming up, as Dan says, Donald Trump is the deal maker, or he'd like to think he is, and we're looking ahead to how all of the trade policy is impacting the economic outlook for two major regions, the US and the Euro area, and what investors should be paying attention to in particular. That's coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Verdon in Dubai. Now, traders are looking ahead to the US jobs report out on Thursday. It's early because of Independence Day, of course, on Friday. US markets taking a holiday. And we already had those muted consumer spending figures for May. Also on the radar, Trump's tax bill debate in the US Congress, as well as global trade talks. So it's a busy week on the docket ahead for you. Let's get a preview with our Bloomberg MLive strategist, Mary Nicola. Mary, good to see you. I want to just start with the US data. We've already had a load on Friday. Now we look ahead to the jobs numbers on Thursday. Are you expecting to see cracks in the labour market showing? And if you do, how much could that persuade the Fed to cut?
Yeah, so the main thing that everyone's going to probably be looking at is the unemployment rate. And the forecast is for an uptick in the unemployment rate, which starts showing that the cracks are really widening in the labor market, because we're seeing some of that coming through in continuing continuing claims. And of course, that we're seeing more people having difficulty finding a job. So I think in general, what traders are going to be looking at is if we start seeing these widening cracks in the labor market, that really is going to tilt in favor of more easing. We've already seen that the rate cut bets have gained traction for September as a result of speculation that, the implication of Powell, someone instead of Powell being named very soon. And of course, the Trump administration is looking for someone who's going to cut a lot more aggressively than where we've seen Powell and the current Fed looking at. So in general, if we start seeing that labor market shift taking place, I think that's really what tilts the scale for the Fed, and where we see market bets starting to increase in favor of more easing, which would then put a lot of pressure on the dollar.
And Mary, we also get the Eurozone CPI print tomorrow, 10 a.m. London time. The expectation is for 2%, the ECB's target, of course, but this would be the first quickening since the start of the year. Is that significant, or should we just be pleased that they're at target?
I think in general, the trend is that there is disinflation in Europe. I think we've seen that for quite some time, and that draws a really sharp contrast to the U.S., where the U.S. you're seeing a little bit of resilience in inflation. You're not seeing disinflation accelerating as fast as we've seen it in the Eurozone, and that largely has to do to some degree on tariffs and how tariffs is impacting the U.S. economy, so not having the same budge as what we're seeing in Europe. But what it is indicative of is the fact that even if the Fed, the ECB, maybe has one or two more cuts priced in, or looking for a few cuts to go, I think the general message is that the combination of looser monetary policy, looser fiscal policy, is an indication of why we are seeing such stronger growth expectations coming out of the Eurozone. And as long as that persists, that's actually going to be a boost for the euro.
And just finally, Mary, if we can look back to Friday's data out of the US, as I say, we had PCE slightly up more than expected. We had the consumer spending figures down in May. Is this the stagflation narrative already taking hold?
Yeah, we've already seen signs of it taking hold, right, where we've seen a lot of the cracks in the U.S. exceptionalism story really coming through. That's in general what's been weighing on the dollar, not so much on stocks, where stocks continue to rally. But where that is becoming more evident is what we're seeing in the U.S. dollar. And as a result, I think especially when we see stagflationary concerns, that's really bad for the currency. Mm-hmm. And in general, we've seen it in previous times where stagflationary concerns weighed on sterling, and they weighed on the yen as well.
OK, Mary Nicola, we thank you, and get the rest of Mary's thoughts on the MLive blog, MLIV Go, on your terminal. We'll get back to the Middle East next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Back on, Canada rescinds its digital services tax in a bid to resume US trade talks. But with just 10 days to go until elevated tariffs are set to resume, the White House looks set to fall short of the sweeping global trade reforms that it promised to achieve. President Trump signals a ceasefire in Gaza that could be coming as soon as this week, but he gives no details on how an agreement might actually unfold. And the Democratic Republic of Congo and Rwanda agree to a US-backed peace deal to end years of deadly conflict. Those are your headlines this morning. It's just gone 8:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai in Fisherman Versace. Welcome to the programme, everybody. We already had the S&P hitting a fresh record on Friday. Today it's the 30th of June, the end of the month, the end of the half, and it looks like from this futures picture we're going to hit another fresh record when it comes to US stocks. stocks. It's all fueled this morning, at least, by the trade optimism, that news on the Canada digital services tax being rescinded, hopes of a deal there, at least, by July 21st. But let's look at the cross-asset picture as well. Flip the board over, and you can see that traders are also braced for Fed cuts. See it in the bond space. The 10-year yield currently at 4.28%. But really the question is, how long can these two assumptions hold? This assumption that US stocks are going to continue to outperform and the assumption that the Fed is going to cut rates in the second half. It's a question that I'm sure we'll return to throughout the week. But flip the board again. I want to show you one more chart, because throughout this first half of the year, you've seen this rally in stocks, bonds, commodities, credit even, but the outlier has been the dollar. And on the flip side of that, you've seen the strength in the euro and in sterling. And if we just focus on the euro here, partly it comes down to the central banking story. So while on the one hand you've got the expectation of Fed cuts later this year, on the other hand there's the expectation that the ECB is pretty much done with its easing cycle. And really, you're going to see that juxtaposition personified this week in Sintra, when you have Jerome Powell and Christine Lagarde side by side at a panel for the first time since that same event a year ago. So we keep an eye on the currency picture in this second half of the year. But let's get back to the latest here in the Middle East. President Trump has suggested that he might back eventual sanctions relief for Iran if Tehran can be peaceful. Trump discussed the possible sanctions relief in a taped interview on Fox News following US strikes, which, of course, were aimed at destroying Iranian nuclear sites.
One of the things I was thinking about doing, you start waiving them for countries like, if they behave themselves like Iran, where they can sell oil and they can do the things that you want to be able to do. The sanctions are very powerful, and it makes it difficult.
Let's bring in Bloomberg's Dana Kraish for more. Dana, just talk us through what does peaceful mean here from a US perspective, and what we would need to see to get a return to talks.
Morning. I think from a U.S. perspective, the U.S. wants Iran to stop enriching uranium altogether, and Trump has said that in the past. But after the war and the U.S. strikes, and of course the Israeli ones, I think Iran will not be able to back down from this as it had done in the past, especially after the war. Right, Tehran and its regime now probably believe they're facing an existential threat. So they may need to keep that leverage, even at the risk of more strikes and more attacks. So even Trump in that Fox interview said Iran might not give up nukes, but they are exhausted. So it is at a very weak point. And also this comes after Trump lashed out at Iran's supreme leader Khamenei, criticizing him for claiming victory and saying the war achieved nothing. So there's a lot of rhetoric, and it's strong, but we are seeing signals that Iran, despite this harsh talk, that they are willing to return to negotiate again. Not sure with the U.S. But certainly there's also this internal debate in Iran on how to move forward after these strikes and how to ensure the regime survive. There's also the debate on the conditions of the nuclear sites that we have seen, of course, in the interview as well, and the damage, the assessment of the damage that the U.S. had done. We saw the IEA Director Grossi saying over the weekend that Iran could again enrich uranium in a matter of months. And those remarks are certainly alarming for both the U.S. and Israel. And Trump threw caution in that interview, saying that, the strike set Iran's nuclear ambition at least for a period of time, without specifying how much. So, and Iran is also remaining tight-lipped about this, as expected, but has said, the damage is serious, and has hinted that the stockpile of the highly enriched uranium was moved before the attacks. So see, there are many unanswered questions here, but I think what is real is that the options that led us to the conflict last week and the war are still there. But of course, and it means this could reignite again at any time. But after that, and after all that we have said, I think the truce, from every perspective, the truce is definitely still holding, and probably the reignition of these attacks might not happen because Trump has been very hard hitting on the truce holding.
A silver lining at least. Dana, we thank you. Bloomberg's UAE Bureau Chief Dana Kraish, thank you for the update. Now, turning to the UAE, because despite its record of managing to thrive during global instability, the Iran-Israel confrontation does pose one of the most stringent tests yet for the country's neutral and open for business stance. We can get more on this with Clementine Munro, who's Haus & Haus Sales Director. Clementine, it's really good to have you with me. Thank you so much for stopping in. This conflict, I feel, must have been the first time for a whole generation of expats that they've been exposed to the risks in the Middle East, particularly when you had those strikes on the US airbase in Qatar. Do you think that it's going to have a lasting impact on sentiment in the region of people living here, moving here, investment sentiment as well, that for the first time they've had to really think about their safety?
I think last week, certainly, there were some uncomfortable conversations that we were having both as management. How do we empower our team to have conversations with buyers and sellers? But the reality is, when there is geopolitical instability in the region, it only makes Dubai look safer.
Yeah.
And anecdotally, our Haus & Haus Holiday Homes department had a huge increase in Iranians seeking shelter in Dubai.
OK, that's really interesting. So Dubai is seen as a safe haven and that continues. Maybe this is even beneficial. What's been driving Dubai's continued price growth then? This has been the underlying trend, even amid the global headwinds, even amid the safer dollar, softer dollar as well.
I think Dubai is just an incredibly safe place to want to be. The Times reports that 16,500 millionaires have left the UK and 9,800 of those have landed into Dubai. And I think what that's talking of is just brilliant infrastructure, the ease of doing business here, just is seen as a really safe place to come.
Well, you mentioned the UK. I wonder, with my UK correspondent hat on, how much that's to do with Dubai benefiting from the Labour government in the UK dismantling the non-dom regime.
Absolutely. That's definitely what we're seeing. And even just the education now here has really caught up, healthcare. I think people, even with things like the private school fees, VAT that went on, it's still much cheaper to educate your children here. And yet, arguably, you're getting the similar quality of education.
And so you're forecasting for that trend to continue?
We are.
OK, because that's a real worry for the Chancellor if more than 1 in 4 non-doms actually leave the UK. So that's really interesting. And then how does Dubai actually stack up globally when it comes to value and investor appeal? Because, of course, there are lots of cities where the non-doms, but other rich and mobile people could go.
And that's it. Dubai is still so affordable. Dubai blends out at an average of $418 per square foot. If you look, that's nearly half of Paris, which is $700 per square foot. And then London, $1,400 a square foot. New York, $1,650. Singapore topping out at $1,750. So it's almost 4 times cheaper to live in Dubai than it is in London. And that's not including the fact that you're also not paying tax on your income here.
And is it the luxury segment that's driving things, or is it also the mass segment? How does it pan out?
I mean, those numbers are a blended average, but what we are seeing is that the mid-level has been pretty buoyant, although with the supply that's coming in the next couple of years, that's a segment to watch. But the prime segment is absolutely flying. OK,
really good to have you with me, Clementine Munro. Thank you so much for joining me here on set. Clementine Munro is Sales Director at Haus & Haus. We thank you. Coming up on the programme, the Democratic Republic of Congo and Rwanda have signed a US-backed peace deal after decades of being at war. So we're going to bring you the latest next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Now to Africa. The Democratic Republic of Congo and Rwanda have signed a US-backed peace deal after decades of being at war. The foreign ministers of both countries agreed to the accord in the White House on Friday with a commitment to cease hostilities and halt support for armed groups. For more, let's bring in Bloomberg's Ondiro Aganga out of Kigali and our Chief Africa correspondent Jennifer Zabasaja, both of whom join us now. Ondiro, good to see you. Just talk us through how this peace deal actually came about after all of this time. And the big question, is it going to last?
Lizzie, this has been a long time coming. Conflict in the eastern part of the Democratic Republic of Congo has been going on for nearly 3 decades. 6 million people have been displaced. Hundreds of thousands have lost their lives. And the humanitarian crisis is worsening by the day. And so it was time that something needed to give. And what started as a letter by the Democratic Republic of Congo to the United States for minerals in exchange of security has now materialized into a peace deal. And the logic for DRC is that if U.S. is invested in the region, if they have investment, if they have key interests in the region, then they will have to pay not only political attention, but maintain that big brother role to maintain peace and stability in the region, because then they have investment that they care about in the region. But to also ensure that this peace deal lasts, because it comes after several failed processes, the Rwanda process, the Nairobi process. The U.S. has thrown in there an economic pact to act as an insurance clause. And what they want to do is ensure economic integration within the region so that there's enough incentive to maintain peace. They want to do joint infrastructure projects, including railway and road, build a hydropower project worth $760 million, providing 206 megawatts of electricity, not just to DRC, but also Rwanda and Burundi, and create revenue sharing mechanisms when it comes to minerals. However, there will be challenges. This deal is between Rwanda and the Democratic Republic of Congo. There's no binding agreement with M23 rebels who've captured 2 significant cities in the eastern part of DRC. And even though Rwanda has said that they're going to support peace talks between DRC and M23, it's yet to be seen, because the bigger question here is always going to be minerals. And beyond M23, there are more than 100 other armed groups in the region.
Yeah, and I want to come back to the minerals picture, but Jen, you've spent years tracking every twist and turn on the way towards this peace deal. What do you make of the timing of it?
Yeah, I mean, Lizzie and Dira was just pointing out some of the previous failed attempts at actually getting here. We should point out that there's actually been quite a few attempts by previous U.S. administrations trying to get to this point. So this is significant for the Trump administration. Yes, he's even touted the fact that he should receive the Nobel Peace Prize. But we should note that this is a concerted effort by the U.S. administration that started before the Trump administration to really counter China's impact in the region. We should point out this region between the DRC and Rwanda accounts for some of the biggest reserves of mineral deposits, and Dira was just pointing it out there. And so this is about broader than just security. This is about some of this economic integration that she was just talking about there, and really how the U.S. can step in and find ways to mutually benefit itself. And so, yes, of course, this is a security guarantee, which is what the DRC president wanted in exchange for at least starting these talks and trying to resolve some of the disputes that they had with Rwanda. But again, this dates before this administration, and it really remains to be seen whether it remains intact. We just saw video there of the foreign ministers of both the DRC and Rwanda. The question is, will we see the presidents of the DRC and Rwanda getting into the same room? We haven't yet seen that. They are historically known to not like each other very much. And so will they commit to actually dismantling a lot of these militaries that have really inflamed a lot of the fighting in the region? And again, how does this affect the relationship between a lot of this region and a lot of these militias and China, which dates back for decades?
OK, so we need to see how this holds up. But call me an optimist.
Yeah.
Could this be a bit of a domino effect? Could it influence more decisions in the region?
Yeah, I mean, last week I was actually at the U.S. Africa Business Summit in Angola, and that is the hope, right? The one point that a lot of U.S. investors are pointing to is what's called a Lobito corridor, and this is the counter for the U.S. administration to China's Belt and Road Initiative, which, as we know, has been a major investment made by China across the region to try and at least integrate the region, right? And so this is billions of dollars that's been poured into to integrating nations like the DRC, Zambia, Rwanda, and also Angola, and being able to transport minerals from all parts of the region. And so they're hoping that corridors like the Lobito corridor serves as a framework for other corridors that can exist across the region, and hopefully serve as not just an economic framework, but also potentially one that can resolve disputes and resolve decades-long fighting that we've seen in the region. And so the real question, I know, Lizzie, you're saying you're an optimist. The real question is, will it remain intact? On both the U.S. side, they're hoping that U.S. investors remain invested into this because it is essentially, hopefully, going to get minerals and a lot of the deposits that we do need for our electronics to American investors and to a lot of consumers globally. But also, they're hoping that Africans and people in the region will economically benefit from it, right? So they're hoping that a lot of these corridors will create economic incentives and build communities and build frameworks around these corridors that will hopefully incentivize people to stop the fighting and continue to, again, be invested into this. So it really remains to be seen.
Well, let me put my pessimist hat on, Ondiro, because you mentioned this major issue of how you actually stop illegal gold smuggling. Is that going to be achievable when you've got elevated prices, given this context of elevated uncertainty, whether it's on the trade front or whether it comes to the geopolitics as well?
Lizzie, that is the million-dollar question. If you look at a report by UN experts, they say smuggling of gold is big business. A lot of gold that is illegally mined in the Democratic Republic of Congo finds its way into countries like Rwanda before it's then laundered into the global ecosystem. And we've even seen sanctions on this country. There have been sanctions on the CEO of the Rwanda Mines Board, sanctions on Gasabo Gold Refinery because they've been accused of trading in gold from blood and war-torn regions. So there has been that, and that remains a big concern. And as prices rise, and M23 is not under any obligation in this peace deal between Rwanda and DRC, it's going to be harder to get them to step back. They also control a region that is rich in tin and tantalum. They control the largest mine in Rwanda, and these are key minerals that are essential for technological advancement. So that money incentive for them, it's going to make it harder for them to adhere to this peace deal. There are also other hurdles, particularly when it comes to ensuring that minerals are not smuggled out of DRC. We've seen a lot of international backlash on Rwanda, and DRC is shouting on top of every roof and telling everybody that minerals that are coming from the region are smuggled from their country. So we are hoping that this is going to be enough to gatekeep minerals and stop smuggling from the region.
OK, Ondiro, Jen, thank you so much. Excellent reporting all the way up to this peace deal. Let's see now whether it holds. Ondiro Oganga in Kigali and Jennifer Zabasaja in London, thank you both so much. Coming up on the programme, we're going to come back to the Middle East, where countries are looking to Asian banks for loans amid a diversification drive. That's next. This is Bloomberg. Asian banks are fueling a more than $2 billion loan boom in the Middle East, with a flurry of deals launching in recent weeks as borrowers look to diversify their funding sources. Let's get more on this with our Saudi Bureau Chief, Christine Burke, who joins us now from Riyadh. Good to see you, Christine. Just talk us through why this loan boom has been happening, why all the sudden activity, and specifically, why Asia?
Well, good morning, Lizzie. It's good to see you as well. And you're right that we are seeing a recent increase in activity that points to this increasing trend of Middle East borrowers looking to Asia for financing. And specifically what we're talking about here is syndicated loans. Just in the last couple of weeks, we've seen companies including Saudi Electricity and BSF, which is one of Saudi Arabia's biggest banks, coming to the market. We've also had syndicated loans coming from the UAE, from Qatar, and also Kuwait. And all of these are being backed, at least in some part by Asian players, including the Bank of China and also Sumitomo Mitsui. And really, this is down to two key things. The first is that on the Middle East side, borrowers are looking to fund these huge economic transformation agendas, whereby these economies are trying to diversify away from oil. This has led to an increase in borrowing. And as that borrowing has increased, so too has the need to diversify the base of funding. So we're seeing borrowers increasingly look externally. The second is on the part of Asia. So we have seen that there has been a slump in syndicated loan volume coming out of the region, so much so that syndicated loan volume, excluding Japan, is actually at the lowest in a decade. So what that means is that you have these big Asian players looking to deploy capital, looking to fund deals, but not really seeing that there's a lot of opportunity within Asia. So the Middle East right now seems like somewhat of a good fit. You have high credit ratings for a lot of these entities that are borrowing. And at the same time, a lot of these loan deals are giving Asian lenders a bit higher of return than they can find in the region. So somewhat of a symbiotic relationship here, if you will, where the Middle Eastern borrowers need financing, they need to diversify, and Asian banks are looking for deals to get done.
And Christine, just in our last minute here, fold in for us the data out yesterday. It looks like there's been some progress drawing foreign capital to Saudi Arabia. How does that play into all of this?
Yeah, it's kind of part of this narrative because FDI is so important to Saudi Arabia's Vision 2030 strategy to diversify, and the kingdom has been seeing a lot of challenges in drawing in foreign direct investment. What that means is that in theory it just increases this need for borrowing that we're talking about. But the good news is we did get first quarter figures yesterday, and what we saw is that Saudi Arabia had the strongest start to a year for FDI since 2022. And not only that, the fourth quarter figures were revised to show that the fourth quarter brought in the strongest FDI in a year. So I guess the key question now is whether that momentum can sustain, especially given just the tough dynamics that we saw in the second quarter.
OK, Christine Burke, our Saudi Bureau Chief out of Riyadh. Lovely to see you. We thank you for that analysis. Let's check in on these markets in our last minute here. We've got futures pointing higher on both sides of the Atlantic. Remember, the S&P already hit a fresh record. It's first since February on Friday. It's the last day of the month, the last day of the half. Can it power to a new high today? Looks like it so far. Flip over to the cross-asset picture. You've got yields pretty steady, the 10-year at 4.28. You're looking at Brent weaker, 0.2% at $67 a barrel. We're looking now ahead to that OPEC Plus meeting on Sunday, and we'll bring you more analysis of that throughout the week. But that does it for Horizons Middle East and Africa. I've been Lizzie Burden in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.